I'm going to run through a few slides about where we see the world, where we see Australia, and where we see health in particular. And one of the things that I think is really important that we're now changing relative to, say, when I was running forecasting modelling in the Australian Treasury, is we increasingly use our own data. And what I'll be showing you is some of the sort of scope that we can use that data as we go forward. In terms of the other thing we always like to know is where are we now? Because if you know where you are now, you're more likely to get it right when you're trying to forecast going forward. So we've just built a large, an indicator for global activity. Blue is the indicator. So what's in it? Things like global shipping, air freight, a few other leading indicators, and basically gives you 6 months worth of forward projections. What it's sort of saying is the world economy got up to about 4%. It's slowed a bit since then, particularly in Europe, Japan, but it's still doing pretty well. Now, if I go beyond that, what I always say to people is if I'm going to get two economies right in the world economy, the two I want to get right is China and the US. So in the US, despite Trump taking all the credit, they're growing quite well, so around 2.75% this year. Of about half of that, or 0.5 of the 2.75% is tax cuts. So some of that has actually happened. The other thing is the US economy has been recovering for quite a while from the global financial crisis. And so one way to think about it is their domestic demand is quite strong and their unemployment rate is 3.9. And it's probably going to go lower to something like 3.5 as we go forward. So one of the results in the US is you finally got unemployment at sufficiently low levels that it's generated wages. And as it generates wages, you then start to see inflation. And one of the results of that is we're expecting in the red line there, essentially interest rates to increase to about 3.25%. So we've got 5 rate rises this year. And the market's already priced that. So people always say, oh, well, if they're going 5 and the Reserve Bank's doing none, therefore that'll cause a problem. Well, it's already priced. So in other words, if it didn't happen, that would be a concern in terms, and so the currency would probably go up rather than down. The other thing you see, of course, is Trump, and therefore you'll get nervous about global tariffs. This is a busy slide, but on the left-hand side, we're sort of trying to add up how much tariffs have they put on. And so in the red is the ones that we already know about. So he's gone to about $200 billion worth of tariffs. And on the right-hand side, if you look at the red, you could basically say, well, it might take 0.5% off world growth and maybe up to 1% off the US. But if they're doing 2.75, they can sort of do it. The other thing, so of ones that he's announced, you're about halfway down the scale. So even if we doubled what he's already done, you get into the red picture. The other thing generally you see is global studies of tariffs assume that nothing else changes. In other words, you put the tariffs on and you just let them go. So in the Chinese case, what they've already done is they've already cut rates, they've already increased fiscal policy and let their currency go down. So the effect is probably going to be even smaller. So I'm sort of not worried about the trade war. I am worried if they get really bad, because if I double it, then I get the sort of impacts in the black. So you take, 2-3% off China, you take 1.5 to 2 off the US, and you take basically somewhere around about 1.5 to 2 off the global economy. That would be an issue. But at this stage, what we're sort of saying is that this is not good, we don't like it, but we don't think it is going to kill the US economy anytime soon. The other thing is then China. China, I'm not going to take you through the ins and outs, but China, according to the way economists measure it, is now a bigger economy than the US. Okay? So it's a big economy. And if it's growing at around 6.5, which is what it is doing now, 6.5%, then it's actually adding more GDP than it did when it was growing, when it was smaller and growing at 10. A lot of people worry about the debt issues associated with China. We think they can manage it. They're trying to deleverage. But the other thing is, whilst they might be bigger, if you look at the right-hand side, this is like a measure of wealth. So if you look at the, put everything GDP per capita, and you use the 100, which is the very top, as the US. So Australia's about 90% of US GDP per capita. What I'm trying to show in this chart is when countries industrialise, they go up a lot. So unless China somehow shoots itself in the foot, which is always possible, you'd expect them to go a long way. So we see a lot of momentum going forward. The big thing that China's trying to do is it's trying to move away from building widgets, you know, manufacturing sort of stuff, into the service sector. So the service sector is actually the strongest growing part of the economy. It is 55% of their economy, and I think most people accept it's growing at about 8%. So think health, education, tourism, that sort of thing. That's what's really growing. And so when we put all this together, we sort of don't worry too much about the near-term global outlook. 2 or 3 years down the track, when fiscal policy in the States is gone, interest rates are much higher, we think the whole thing will slow. But we don't see a recession. The last thing I'm going to talk about from a global perspective is of currency. And I always say to people, if I really knew what was going to happen to the currency, exactly, I'd be back in Paris or Villefranche, which is a place down between Nice and Monte Carlo. Very nice place. These equations, basically, the red lines are the confidence bars, and they're basically plus or minus 5 cents. That's about as good as I can do. So I've been forecasting these things in the Federal Treasury and NAB for a really long time. And we're expecting the currency to go down a little bit, but not a lot. So we're sort of saying, you know, maybe you could get down to 70, but we think it's, you know, mid-70s. So the currency model says 75 plus or minus 5 at present. And some of that is because we think commodity prices might come down a bit. Okay, so now I'm going to talk a little bit about the Australian economy. I'm sure I'll get asked about elections and politics and all that sort of stuff. What we typically find is people's confidence in business relates pretty much to how their actual sales are going. So they sort of ignore the politics. Now, if you're looking at Australian confidence, and we go out each month and survey 1,400 firms and say, do you think things are going up and down? So we get a confidence read, but more importantly, we get an actual outcome read. Now, the confidence read is about long-run average. So despite, now we're in the field this week, so in a couple of weeks' time we'll have a confidence read, so that might be interesting. We've started asking questions about, if you're worried, why are you worried? So that's what this slide says. So it says the number one thing people are worried about is wages costs. The number two thing they're worried about is the federal government, the pollies. So that'll be probably number one next time. The other one they typically always mention is pressure on margins. So you're not getting as much margin or profit out of a transaction as you had in the past. And then you go to, they don't like the state politicians either. And then they have energy costs. So if you're in South Australia, energy cost is number two. So generally what you see is a story that they're what you'd expect, basically, I suppose. So not a lot of surprises there. So we move from confidence, which is animal spirits, to how did you actually go? Now, the blue line in the middle, and I haven't put Queensland on, but Queensland's about the same as Victoria. The blue line in the middle is the long-run average. So what you're seeing is an economy that is doing better than the long-run average, but recently we've been a bit concerned because it started to slow a bit. We've seen a close up of the gap between the West. One of the things that's different at present we're finding as a bank is that in those conditions you would normally expect business to be out there investing and borrowing off us. They're not doing it. What they're doing is paying off debt, playing around with the balance sheet, and if they've got any spare cash, then they're basically using that to invest. But normally we would be expecting business credit to be running at 8 to 10%. It's currently running at 3%. So it's slightly different to what we normally think, and it's generally everywhere. So everything's sort of come down a bit. Retail is the only one that's sort of down at 0. So retail is very different. And so if I sort of blow that up by industry, this is another indicator that sort of says to us, well, the red line is our new orders, so forget about profits, because if you've got a lot of profits, normally that sort of feeds to investment, but that mechanism's not working. But the red line is basically coming down a bit, but it's still sitting at, let's say, 3 to 3.5 in the domestic economy. by industry, this is where you get different things. So red is confidence, blue is conditions, and +5 is like the long run average. So unlike for a number of years, just at present, the miners are doing really well. Why? Because commodity prices are still high. Ask, thermal coal, and basically it's really high, but they're not investing too much now, and so it's just going straight through their profits. The other sectors that tend to do well is the property sector here, so building apartments. I mean, Brisbane, you guys know about that. Construction. The sectors that are weak are down this end here, down in the wholesale and particularly the discretionary retail. I'll come back to that because that is probably the number one issue. And really what's the number one issue is you're not getting much wages growth. You're getting big increases in your utility prices. Your house is not as valuable as it used to be, and you're carrying a lot of debt. So you will pay what you have to pay and think you have to pay, but you won't spend that's discretionary. And until you get some more income into the consumers, they're not going to recover. And so that's the one that I think worries us about an economy. Now, because we do these sort of things and have done them for 20 years and it's sort of considered in the market really important because the Reserve Bank looks at it, we then can start doing things like run the same survey for the health side. So I'll show you some of those sort of results now. So the black line over here is the total economy. So red is essentially trading, grey is profits, and blue is employment. But this is the sort of where health is on average. If you look at allied health, they're doing more, so they're doing a lot more trading. You're looking at profitability in terms of dental services, it's sort of in the middle, and essentially GP specialist, difference in terms of profitability. But overall what you're getting, and recently what I was saying was that reading there of 12 in July has come down a little bit again. But what it's sort of saying is health is doing pretty well in terms of the general economy, doing better. But there are differences as you go in various sectors. And there's differences in the size of the practice and big differences as to whether you're country or rural. The other thing we can then start asking is questions specific to the health industry. So on the left-hand side we said, do you think Australia has a world-class health system? And black is basically saying yes. So most people think Australia has a world-class health system. Then you ask them, what's going to happen in 10 years' time? And they're much less sort of convinced that this is a great system or will be a great system. You can then ask them why, or what are the big issues out there: obesity, mental health, diabetes. And you do get a big difference between, when you get down to Alzheimer's, a big difference between if you're actually dealing with it, which is basically the GPs, versus allied health. And then you can go down the bottom as to what they're not worried about. So you do get a richer sort of idea of where the health sector is. The other thing that you can start doing is you can start looking at data. And as I said before, in some of the areas, like when we do our retail sales version for the economy, we're doing 3 million electronic transactions a day. When we get to consumption, which includes health, we're doing 5 million transactions a day. So we're using, the other thing we have is essentially Metfin. So we can look at Metfin and we can then look at what the Bureau of Stats down here is saying actually happened to health consumption. The nice thing about Metfin is basically it's almost 100%. ICAP. Oh, sorry, HICAP. So HICAPs will give you just about everything you got in the allied health. You can then also then start breaking it up. So this is the HICAP's data by state and by type of service. So we're in Queensland at present, and what you see, for whatever reasons, dental services is really quite strong. Everyone's strong in allied health, and then some other areas are sort of in trouble, physio services in the Northern Territory, etc. But dental is really very strong in the HICAP space. And so if you want to, we will have in each what's called local government area, but essentially think postcodes. So we can sort of look by postcode of what's going on. We do have sort of areas that we say in a postcode, if there's less than 30 of a particular type, we don't count it. And so that's why you're up in the far north, you basically don't have a reading for that. Now, high caps is great, but it doesn't include essentially GPs and the others. So what we can also then do is look at our own database. So basically what we're doing here is we're looking at pharmacies. And in terms of the spend, we've got about 2.7 million transactions a day. And so we can then take that down by local area, and you can see that for whatever reasons, just north of the border has been growing really strongly. If you're looking at some of these areas down in Victoria, what's happening there is there's a lot of transactions, but they're not basically making much profit. So the profit level has been cut in that area. So this is what our data shows in terms of Brisbane, and where are you in terms of which suburbs doing where. Now, when we did it last year, we talked about cost of root canals per suburb, etc., which was interesting because for whatever reason, around the Sunshine Coast, they were about the most expensive in Australia. So that's the sort of way we try and look at our data to get a better feel. Okay, so now I'm going to come back and talk a little bit about what's actually happening in the consumer. So the way we look at this is we look at essentially what consumers say they're spending more on. And so that's the zero line. So what are they spending more on? Essentially utility prices. What are they then also doing a lot of? Paying off debt. Then what are they doing here that's still doing better? It's basically things you've got to have. So health, children, food, transport. And then down the bottom, discretionary retail. So that is sort of, again, the sort of story we see all the time. And we put out a cashless retail sales measure today that said July was essentially flat. So that's about 3 million transactions a day. And we see that also when we go and looking at defaults. That's where the defaults are within our own book. So wages, one of the things about wages, so we look over here, this is what they're publishing. Red is sort of our forecast going forward. That's the last observation there at about a 0.5. So it's about 2% per annum. Three things that are really driving this down. Our models are saying it should be going up faster, but it's not. It's a global issue. What you're seeing is low productivity. You're seeing really low CPI, and the labour market is essentially more slack than you think. So the way I would sort of explain that is if you've got unemployment at 5.5, remember you needed 3.9 in the US to get wages going, so we're 5.5. But if I take that 5.5 and I then add on those who are basically given up trying to get a job, or those that are working 10 hours rather than 40 hours, the unemployment rate is 14 and not coming down. So what I'm now you can say it's a gig economy and all that sort of stuff. The reason that a lot of people are hopeful is the black line. So I've just taken that underutilisation rate, which was around about 14%. The black line here is an inverse of how hard is it to get labour. So as it goes lower, it becomes more difficult to get labour. So what this is saying is if people are finding it hard to get labour, eventually you'll start to get some wage pressure. But it hasn't happened yet. And I think that's really important, because until that happens, the Reserve Bank's not doing anything. And so I'll come back to it in a minute, but we don't have a rate rise for another 12 months. And we're thinking internally about whether we're too optimistic and whether we should shove the whole thing to 2020. But until they get that fixed, and that's also part of the politics where everyone wants to give you a tax cut, is sort of the bottom line there. Inflation, we don't have a problem in inflation. You might see it starting to go back up, but that is basically in 2020. So nothing's going to happen for a really long time. And until you get wages growing at 3, you won't get inflation above 2. And you've also got a lot of competitors coming in online. The average ROE on a retailer in Australia is 25%. So that's why the one area of the economy we don't like, every foreigner is coming here. So, you know, Amazon's coming, Kaisman's come, Aldi's coming, they're all coming because the margins are so high, and so they'll keep the pressure on that as you go down. I always get asked about house prices. So, I think one way to look at house prices that we used at the OECD, and I think you should use it, don't look at the last month, don't look at the 12 months too, because a lot of history. Take the last 6 months and annualise it. If you do that, you get a couple of observations. Number one, you see that Sydney has gone from 25% growth rates down to -10, and then it's about -5. Melbourne's done the same sort of thing, it's caught up. Brisbane is sort of running along at flat. Now, and so really it's a big adjustment. The other thing you can see is people are getting very uptight about, if you're in Sydney, the fact that house prices are down 7%. But if I go back and I count, when was the last trough down here? And then you see these sort of increases. 7% fall over the last 6 months. If I go back to the previous trough, it's up 30%. So if you're worried about the 7%, why aren't you happy about the fact you're still 30% up on what you were 3 years ago? Now, 3 things matter in terms of house prices for us: supply, demand, what the interest rate is, and do you have a job? And what we find, and I'll show you a bit more of this, do you have a job is critical. So we think in the general houses market, and this is true in Brisbane, that houses are basically where they should be in terms of supply demand. The apartment market is very different, and I'll show you that, and you won't like this, but I showed the Perth same sort of story, and they didn't like that either. But supply demand in housing is fine. Interest rates not going anywhere. About 8% unemployment causes stress. So the simplest way to think about that is that in Australia there's 60 postcodes that no banks like. We don't like them. So they're in far north, they're miners basically. And 60 postcodes is 1% of Australian postcodes. 1% of Australian postcodes in the NAB book explains the best part of 50% of all our bad debts. It's a postcode issue. I hear that Australian markets are going to crash and blah, blah, blah. If you give me 8 to 9% unemployment, yeah, you've got a problem. But until you give me that, then I'm sort of saying this is local and you need to watch. So supply demand, what we do is we look over the last 30 years and say if your population's grown by X, you should be building Y apartments and Z houses. So what's it look like? The dotted line through the middle there is the 30-year average. Black is houses, red is apartments. Now, so obviously we don't like that. However, using a 30-year average is different because over the last 30 years you have not had the sort of foreign investment in the apartment markets that we currently got. So our best guess in Sydney, Melbourne and Brisbane is about 80% of those apartments are foreign owned or foreign financed. How do we get that? We go around and we count the apartment towers. We know which ones we're doing, ANZ, CBA, Westpac. The ones we don't know are probably foreign because we're certainly not funding them. So NAB is normally 30% of everything in business. We're 3% in that market. So what we sort of see is we see that this is an activity effect that basically will go through a cycle, but it's not necessarily going to flow into an apartment crash that crashes houses. That's just not going to happen. Okay, the other thing I sort of put up, because everyone sort of says if rates go up 2%, we're stuffed. Well, we run models and they're not great, but what we sort of do is we look at sensitivity. So if you increase rates by 1%, 2%, we're saying house prices based on the history would probably fall 7, let's call it 10%. That would take 1% off GDP. It would not crash you. But if you then start playing with the unemployment rate, you very quickly get a very different result. And if you're really stupid and put up rates at the same time, as unemployment's going up, which they'll never do, but you'll crash the market. So that's the sensitivities that are really important to understand in terms of the dynamics. Okay, so going forward, what we sort of have in Brisbane is essentially a flat outcome, and we don't like apartments. Now that's across Brisbane, so if you go into the CBD where you have these big clusters, I'll use the Docklands because I'm not in Melbourne. Docklands is like CBD in Melbourne. We have prices in apartments down, 1.5%, 2%. Docklands, it's over 20% full. So they're the sort of things that I think. So I don't see that as a systemic issue. I just see that as a soft landing, but it's sort of not bad. Okay, I've talked a lot about negative things. I'm going to talk a few positive things. Infrastructure. So what we've tried to do here is just list up every project we know in Sydney and Melbourne in terms of infrastructure spend. It comes right down a lot, but that's because you can only get the data out of the budget documents. And after 3 years, it all disappears. All right? So what we really think is infrastructure is about 25 billion a year. The mining boom was 125 billion. So it's like, 20% mining boom. It also will probably flow into private sector investment as well. So we see that as adding a lot to growth. National disabilities is adding a lot of spending in terms of employment as well. So the public sector is strong. Also the other thing, for the last few years, and you've got some of these LNG platforms, they've been building them, and then so nobody's making any money of them. You're not going to be employing anybody now, but they'll be counted for GDP because you're exporting them. So there will be these artificial things that will keep GDP up. So for us, if you look at through the year growth rates, we do have it around 3, so we're 2 3/4 sort of thing, and then we trail it down to about 2.5. Why? Because once you get through the one-offs, you're back to the consumer. And that sort of still makes us feel nervous. So also for us, we have unemployment going down to about 5%, but not until this time next year. And once you get to that sort of level, you might just get some wage pressures, and you might get the RBA starting to think about it. As I said before, for us, and this is my final slide, we think they're not going to do anything. APRA's been doing the work for them in terms of tightening up investor lending, and we have essentially a period where nothing happens for ages, and then we have a very, very tiny increase. And as I said earlier, we may actually delay that to 2020. And it's nowhere near what you might call a long-run average interest rate. So my sort of view is it's going to look pretty good. Health is doing better. Rates are not going to do much at all. But most people are going to feel like it's not as strong as what the statisticians say. So there's some technical issues. So last thing I'd say, this morning we put out an anxiety report. And the anxiety report, this was taken for June quarter, so it's not the pollies, it jumped up a lot. So people don't think that they have enough money to satisfy their cost of living requirements. So we've gone from a record low to almost a record high in a quarter. So that's, again, this idea that people are nervous, and until they do, they won't spend on discretionary retail.